Hello and welcome. You're watching KYC. I'm Hersh Sayta. We'll today look at City Union Bank, and what I want to really know within this mid to small cap banking space is 3-4 things key which stand out for me when it comes to a City Union Bank. One, what's their growth strategy? Growth has been muted, has been weak. Last 3-4 years have been a bit of a drag, but does that change going forward? They've guided for decent growth. How sustainable, how long is really the question. The second one is they have a large geographic concentration, whether that is expected to change short term and more so long term. Is there a thought process behind changing that? Third piece is with regard to recovery pipeline. They've spoken a lot in their calls about how recoveries is going to outstrip slippages. What is the recovery pipeline? Their PCR has gone up, so where should your provisioning coverage ratio go? And all of those factors around asset quality, and whether the past, which has been slightly checkered in terms of provisioning, is now firmly behind them. Last off is with regard to ROA stability. Can they maintain that ROA at 1.5, and is there any upside potential to that ROA number? So all of that and more as we speak about City Union Bank. But first off, I want to quickly talk about the company and quickly get you perspective on where this company is from. It was incorporated in 1904. Tamil Nadu was its presence, continues to be a predominant presence in Tamil Nadu. It's one of the oldest and largest or rather oldest private sector banks in India, can't be the largest. It operates around 875 branches, around 1736 ATMs nationwide, and has a very, very strong presence in South India. Out of those 875, 732 branches are in South India, of which 550 are in Tamil Nadu in particular. So it's got a large presence in Tamil Nadu. Let's also look at the branch mix now. Before we go to the exact states in which they have branches, I want to look and give you perspective on each of these. Rural is the lowest focus for this one, around 171 branches in rural. Metro is around 203, semi-urban is 215, and urban is 286. So a large part of where their presence lies is beyond tier 2 and beyond rather. Metro is something which they have the least presence in after rural. So that's broadly the mix. But it's a decent mix, to be frank. With an 875 branch count, that mix seems to be well shaped. In terms of branch geography, their maximum is in Tamil Nadu, as is evident. Then you have less than 10% in all of the others, you know, Karnataka, Andhra, Telangana, Maharashtra. But you look at that 550 out of 875, that's a very, very significant number in terms of the presence in Tamil Nadu. 60 to 70% presence, which is extremely large. The current strategy and how they're looking at business. They're looking at digital loan origination. That's what they are currently pushing. They have part of this is the credit assessment and risk-based pricing, which they are beginning to implement. They have BCG, and BCG has helped them implement digital lending initiatives. The bank is also focused on pre-qualified / unsecured personal and business loans. That's one place they are focused on. But now let's look at the loan mix, because that is essential to understand what the bank is up to. The largest focus again here, the concentration is very large. The largest focus, 41%, is MSME. So when you're looking at the loan mix share, it continues to be very, very large where MSME is concerned. You can see that 41%. Then there are some others, agri, joint liability, non-agri, all of those start taking center stage. So those two pockets, agri and joint liability, non-agri, is around 30%. Again, the concentration, 70% of their loans, MSME, agri and joint liability, non-agri. That's 69 or nearly 70% of their loan book. So again, something in terms of the concentration that the bank has been rather lending to in terms of cohort is extremely sharp. Then you have some of the others: commercial real estate 7%, housing 5%, NBFC 2%, personal loan 2%, wholesale trader 2%, loan against deposits, retail traders, large industries, infra. Then you have all of these within the 2 to 1% bracket. But really, that concentration in those three buckets is what I would be most worried about. So, well, that's with regard to what the company is doing at this point. They were pulled up by the RBI a year or so back with regard to lower provisioning that they have done, and therefore the stock went into a long period of consolidation. The bank had to correct some processes. These are also systemic issues within the bank which were present, which now the bank claims they're out of the woods. I'd want to understand and get more clarity on that as well. But let's talk about the metrics first. What is it that we will be looking for? We'll start off with the income statement, the balance sheet, the operational metrics, as we always do when it comes to banks, and then we look at asset quality as well. Thereafter, we look at shareholding, street cred, street coverage, and valuations. We'll cap that up and we'll give you a rating out of 8 at the end of it. Let's start off with the income statement. Now, when you're looking at the numbers, FY22 to FY25, what is it that you're seeing as a viewer? You're just seeing an 8% NII growth, 2% operating profit growth, while provisioning has come down significantly. What you're on a higher base, of course, and hence I'm saying significantly. Otherwise, in absolute terms, it's just 13% lower on a CAGR basis. But profit is getting a lift because of that. So you want to, do you want as an investor, do you want profitability to come from lower provisioning, or would you want profitability to come from higher growth? And this is not a bank which is substantially large. It's a 50,000 crore AUM bank. What you would want is stronger growth. And that's not coming. That's not reflecting on the net interest income or on the operating profit for that matter. So therefore, we've given this a strong thumbs down. Provisioning has had its set of issues as well. I did say that. And therefore, again, even on the provisioning front, how stable is this number is something we'll ask. But that's how the last 3 years' numbers have evolved. FY23, FY24, FY25. So it's largely in the 500 to 550 range in the last couple of years, but FY23 again was elevated, the provisioning number. And that kind of drags the bank down as well. So all of that not adding up very well. And that's why you're seeing a thumbs down on your screen when it comes to the income statement. Not too happy. You'd want more with regard to the income statement. Let's look at the balance sheet now. Again, what you're seeing is an 8% to 9% growth on the advances front. The deposits have grown slightly better at 10%, and CASA is up around 11.5 odd percent. So maybe on the CASA front, maybe it's slightly better, but outside of that, you're not seeing growth. I mean, you're just about seeing a double-digit 3-year CAGR growth on the deposit number. Wouldn't you want more on a deposit base of 60,000 crore? For sure. And therefore, again, here, the numbers don't look very enthusing. You want a better number. The only piece here is the capital adequacy. It's poised at 24% to do decent amount of growth, at least going forward. Now, whether they capitalize on that or not is really the question. But at least the capital adequacy looks okay. They haven't done any equity funding round since a while now. So the balance sheet from that standpoint is okay. There's no dilution of shareholders' equity. But what you're otherwise seeing is just very, very low growth on an otherwise extremely low base. So maybe a lot more to be desired on that count as well. Now let's look at operational metrics and let's put this into better perspective. Look at the way in which your yield on advances has gone up, just about 50 basis points since FY23. Even your cost of deposits has gone up, and that's also to a certain extent due to the repo rate as well. You want to factor that in. Your net interest margin has largely been stable, so that's the impressive bit. 3.9, 3.7, 3.6 is largely stable net interest margin. What you're seeing on the cost to income side, it's seen a bit of a spike, but at least last 2 years it's been decently stable. But really the essence of it is the ROA. 1.46 to 1.55 is not a bad range to hover around, and they've done that for 3 years on the trot now. Mind you, FY23 was a year in which provisioning was elevated as well. So despite that, the ROA number doesn't look too bad per se. So it's been a steady kind of a number on the ROA count as well. Largely, we'd see this number as a steady number, and therefore we've given this a neutral rating where the operational metrics are concerned. Now let's talk about asset quality. This is where you start to see a little bit of improvement of a high base. 4.4% GNPA in FY23. FY24 it tapers down to 4. FY25 it tapers down to 3.1. So you're seeing that improvement year on year on the GNPA number. Clearly a thumbs up. You look at the NNPA number as well, it's largely in that kind of a bracket. And the NNPA number has come down from 2.4 to 2 to 1.3, as you can see on your screen. So a thumbs up when it comes to the GNPA and NNPA. I also want to quickly zoom in. Q2, the GNPA number was 3.5%. Q3, it was 3.36%. Q4, it's 3.1%. So you're seeing steady improvement even when I'm looking at the last 3 quarters in terms of GNPA. NNPA also very similar trajectory, 1.62, 1.42, 1.25. That's how the NNPA number has come down by in the last 3 quarters. So a thumbs up on that count where asset quality is concerned. Credit where credit is due. They've improved their asset quality. They've improved their provisioning coverage ratio, which is the coverage on the NPA number has gone up, which is again a positive. They've provided, they've over provided, they're being conservative. All of those are positive points. Let's talk about shareholding now. Now there isn't a single promoter in this bank, and therefore you would want to look at what kind of institutional investors are sitting here. You look at the December 24 numbers, you look at the March 25 numbers, there are some numbers which are already sitting there in front of you. But let me quickly read out some numbers on an annual basis. FIIs originally were holding around 20 to 21% of the share capital in FY20, came down to 18% by FY22 and has risen back to 28% by FY25. So steep FII interest that we've seen over the last couple of years. DIIs on the contrary used to hold 30 to 35%. Holdings inched up in FY22 to 40%, and now they've tapered back down towards the 29 to 33% kind of band. As usual, the tug of war between FIIs and DIIs seems to be evident here in the shareholding. The public holding has been around the 42 to 39% kind of number, or maybe 43 to 38% kind of number. That's the kind of band that public shareholding has stood at, in particular with regard to this one. I want to also try and point out that there are some very interesting institutional investors sitting here. Let's pull out that list and we'll get perspective. There you go. And HDFC AMC holds around 9% and SBI AMC 8%. Capital Group is the other one, and Franklin India. And again, then you have a combination. You have Axis, ICICI, all of those mutual funds, AMCs holding roughly 8 to 9%, including a Kotak AMC holding around 8 to 9% stake in this one. So you've got these clutch of investors and AMCs which really seem to like the stock and therefore have decent amount of holding in it, which kind of gives you some bit of comfort, right? That you've got these large institutional investors which are holding large stakes. Not that it doesn't mean that they will exit at some point. They might. But what I'm saying is it gives you comfort. It lends comfort that there are several of these large ones, and therefore there's something that they are seeing in terms of positivity with regard to the bank. And therefore, we've given this one a thumbs up because of the uniqueness of the way in which this is structured. Let's look at street cred now. Again, an interesting picture. You look at the 1 month returns, it's up 1.5%. 3 months, it's up 16%. 6 months, it's up 6%. And 1 year, it's up 31%. All of this looks good till you zoom out and look at the 5-year picture. That's where the problem lies. 43% returns in the last 5 years is a far cry from satisfying. And therefore, again, you want to see more with regard to the performance over the longer period, and hence we've given this one a neutral. Now let's look at the street cred. What is it, the street coverage. What is it that the analysts are suggesting? There's only one sell call, the 26 buy calls, and the average upside is just 10%. Again, we'll give this a neutral because what you want to see is more. Have you already seen a larger part of the rally having been done or not is really the question. While there are 26 buy calls for sure, the upside is not as compelling at this point. I want to also look at the valuation picture because that will also give us a clearer picture as to how this is stacking up in terms of peers. You look at City Union versus some of the others. Now I understand that the ROA picture for some of the others may be different, and that's something that you must also note. But the price to book at 1.5 times and the recent stock rally, again, the valuations will likely price in a decentish growth and a 1.5 to 1.6% ROA. Can it beat some of those expectations will be the question. And before I go across to N Kamakodi, who's joining us, who's the CEO at City Union Bank, who's joining us, before I go across to him, let's quickly stack up the KYC ratings in front of us for our perspective. The income statement and the balance sheet are a thumbs down. You want more with regard to growth. Operational metrics are a neutral. Asset quality is a thumbs up. Let's look at shareholding, street cred, street coverage, and valuations. All of that stacks up to a 4 out of 8 on our KYC ratings for a City Union Bank. Now let's go across to N Kamakodi, who's joining us. Mr. Kamakodi, always good speaking with you. Good morning. I want to start off by asking you that you've guided for around a 200 to 300 basis points higher growth than industry. What's capping your growth at this point? I mean, you're well capitalized, your PCR has gone up, you should be happy with the way asset quality metrics are evolving. So what's capping and what's keeping you cautious with regard to growth on a loan book which is 50,000 crore?
See, if you look into any bank, the actual mistakes are made in good times. So we had always maintained, like say, we are test match players. We are not a short-term player, like where we want to have, like say, a 10% over and above the industry and take it and all. We take a cautious, like say, a treaded path where, like say, our growth rate almost, like say, a few percentage point over and above the growth rate of the industry, so that, like say, we have a total comfort over the risk metrics and also on the growth per se. So this had all along been our practice. This is how the bank had stayed profitable and efficient for 120 years over the since it was, like say, started. So we continue with the basics so that, like say, we take a growth, like say, about 2 to 3% over and above that of the industry.
But what will help you grow faster, or will you just avoid growing faster just because you're being cautious? Other banks have proven that they can grow faster along with being cautious with regard to asset quality. So what's stopping you from doing that? Because you've already ironed out some processes as well within the bank.
See, basically, all the banks which you say, like say, they had their growth for, like say, 2 decades or 3 decades. But particularly when a bank has a larger, like say, time horizon to take care, you might have already seen all the traditional banks which tried to accelerate the growth. The experience had not been that good. So it will be a measured growth over and above that of the industry. That's why we survived without any issue during the your AQR period or during the asset quality cycle of your corporate consortium lending or your infrastructure lending period and things like that. You had a period when the maximum growth happened through the unsecured segment, which we have kept ourselves away. So we will continue with our long-term proven strategy of, and we don't burn the capital also unnecessarily. So we take a decent return both in terms of ROA and ROE. measure the growth, like say slightly above that of the industries. We take a relatively cautious path, which has been a proven thing, and this is our strategy, which is we have demonstrated and communicated in no uncertain terms.
Sure. So a steady growth that you will likely see, will it be a consistent growth as well? Are you expecting to see a 13 to 15% kind of growth clip continue for the next 5 years, and therefore will you double your advances book in the next 5 years? Is that the way to look at this one?
Yeah, we had been doing that way till the COVID. After that, we had a round of, like say, some setbacks in between. After that, we are getting back to that rhythm, and this is how we are doing. Like say, if you had a chance to look into our number up to 2020, that is how we had built up our franchise. Across all matrices, we had that 15% plus growth for about 15 years continuously.
Okay. When I'm looking at the other piece that kind of draws my attention is concentration, both in geography as well as in loan mix. Is there a thought process to diversify from that, and how quickly can you do that?
How do you say on loan mix?
So MSME and MSME agri are a predominant part of your loan mix. You also have joint liability, non-agri, which is 12%. So when I'm combining those three, it's amounting to 70%. Do you believe that that's too concentrated, or you feel that you're comfortable with that?
See, within that, the exposures are granular and don't call it as a concentration. Like say, even if you look into the MSME metrics, the MSME within that, it comes from the different types of industry. So I don't agree with that point of view of, like say, viewing it as a concentration. But yes, we had been a traditional Tamil Nadu-based bank. We just reached a level of, like say, saturating Tamil Nadu. So over the last 5 years, about 60% of our branches got opened in non-Tamil Nadu. Slowly and steadily, we are expanding to non-Tamil Nadu state. So, like say, maybe like if you look into the next 10-year basis, the Tamil Nadu contribution will come below 50%. This is how traditional private sector banks have expanded in the past.
Okay, and is there scope for ROA expansion? And I ask you this question because when you're looking at your cost to income, it's seen a bit of a spike. Do you expect these levels of cost to income to sustain on the growth that you're now expecting, or do you expect cost to income to start to aid your ROA? Just trying to understand that metric.
Basically, like say, before making investment in the capacity expansion, we used to have a cost to income ratio between 40 and 42%. And at the current level, once, like say, as we had already communicated during our earlier conference calls and all, we had created certain capacities in certain lines of activities, like including retail and other areas, where we expect like last year we had taken P&L impact, and this year it should be getting into the what you call your break-even period, and next year itself they will be starting to contribute for the incremental profitability when you will start seeing the like say from next year, I mean 26-27, when you will start seeing the cost to income ratio coming down, and we expect the cost to income ratio to stabilize around 45% over the period of 5 years, like by reducing about 1.5% every year or so. And to directly answer your question, how to see ROAs expanding, if the good credit cycle extends for, like say, another 4 to 5 years, so our once we get below the 0.5% net NPA level, the incremental credit cost, already we have reached a stage where our NPA recoveries are more than the NPA slippages for the past like say 3-4 quarters, which means that the incremental provisioning that is getting made or directly utilizing for reducing the net NPA percentage and improve the coverage ratio, which you have already started seeing. So when that number further reduces, probably like the credit cost may further reduce, and whatever savings we make in the credit cost, it will get added into the ROA. So another 10-20 basis point to improve in the next 3 to 5 years time frame, there is a visibility.
Okay, okay, point taken. Thank you so much, Mr. Kamakodi, for coming in, speaking with us, and helping us decode City Union Bank this morning. But completely out of time on this edition of KYC. Before I leave you, I want to quickly look at the KYC metrics one last time. That's how the KYC rating parameters stack up in terms of thumbs up, neutral, thumbs down, and that's how the rating stacks up. But with that, completely out of time on this edition of KYC. Stay tuned to NDTV Profit. More action on the other side.